Hi everyone, welcome back to Joel Income Journal. You've been following my channel. You know that I talk a lot about building passive income through high-yield ETFs and smart portfolio management. Today I want to go deeper into something that often gets misunderstood, and that is margin. Margin can be powerful if used wisely, but it can also destroy your portfolio if used recklessly. So in this video, I'm going to show you exactly how I use margin safely, how I manage the risk, and why I'm not losing sleep even when the markets get volatile. Now, before I begin, just a reminder that I'm not a financial advisor. Everything I share here is for educational and entertainment purposes only. It is based on my personal investing experience. Please do your own research and make sure that any decision you make fits your risk tolerance. Alright, let's get into it. So what is margin? Alright, let's start with the basics. Margin is essentially borrowing money from your broker to buy more assets, using your existing portfolio as collateral. You still pay interest on that borrowed amount, but it lets you have more buying power without selling your investments. For example, if you have a $100,000 portfolio and you borrow $10,000 using margin, your total exposure becomes $110,000. If the market goes up, you make slightly more. But if market falls, your losses also grows faster. So margin is a double-edged sword. It amplifies both gains and losses. So why I use margin? I use margin as a tool for flexibility, not as a shortcut to get rich. It allows me to take advantage of market dips without selling existing holdings, keep my cash invested and working, maintain a steady income flow from high-yield ETFs. Every borrowed dollar in my account is linked to an income-generating asset. I don't use margin to buy speculative growth stock or chase short-term trades. If I borrow, it must create cash flow. Otherwise, it is not worth it. Now, just to share my current margin usage, here's an illustration of my own portfolio. As of 10th November, my portfolio value is about USD $137,000. My margin loan in Interactive Brokers is around US $7,800, and this is about 5.7% of my total portfolio. My margin interest rate with Interactive Brokers is at 6.87% per year, and I hold around $50,000 worth of S-Gulf, which are short-term US Treasury ETFs earning about 4% yield. This means that my borrowing cost is roughly $45 per month, while my portfolio generates about over $3,000 per month in dividends. So the margin interest takes up less than 1.5 to 2% of my monthly income, which is completely manageable. Right now, I'm using about 5.7% margin to equity ratio. That's considered very conservative. Even if my portfolio drops 20%, I still have plenty of buffer before any kind of margin call. Now, to give you perspective, margin calls are typically triggered when the value of the securities in the account declines due to market downturns or volatility. They require immediate action. Investors must add funds or sell assets to restore the account's value. Failure to meet a margin call can lead to broker to liquidate assets to cover the shortfall. So I'm nowhere near that, and I plan to keep it that way. As I said, I also have $50,000 in SGOV, which is a very liquid, low volatility ETF. And this acts as my emergency collateral. If the market drops suddenly, I can sell part of my S-Gulf instantly and repay margin the same day. That's what gives me a peace of mind. Now, let's look at how people get into trouble. Alright, say for investor A, who is a safe margin user, like me. Let's say he has a portfolio value of $100,000. The margin loan is $5,000, which is 5%. Alright, so if the market drops 20%, the portfolio value becomes $80,000. This is still fine because the margin ratio stays around 6%, no issue. Now, let's look at investor B. Now, let's imagine investor B who has a portfolio worth $100,000 and decides to borrow $50,000 on margin to buy more stocks. That means investor B now controls $150,000 worth of asset, but half of that money isn't his. It's borrowed from the broker. Now imagine the market takes the 20% dip. When that happens, the total portfolio value falls from 150,000 to 120,000 because 20% of 150K is $30,000 loss. The debt to the broker is still $50,000. That doesn't change. So the investor's equity, which is what actually belongs to him, becomes $70,000. Okay, because 120K minus 50K is 70K. Now let's look at the margin level, which is equity divided by the total assets. The margin level is now $70,000 divided by 120K, which is 58%. So portfolio 100K, margin loan 50K. The market drops 20%, portfolio value becomes 80K. Now the equity is 30K and debt is 50K. Margin level is 37.5%. This is dangerously close to a margin call. Alright, if the broker's maintenance requirement is 35%, any small additional drop can trigger a forced liquidation. And this is how people get wiped out. Not because margin itself is bad, but because they borrowed too much relative to what they own. Now let's talk about the cost side. At 6.87% per year, my 7.8K margin loan costs me about $536 per year, or roughly $45 per month. That's easily covered by my monthly dividends. In fact, even my S-Gulf holdings earns about 4%, so that yield alone offset a big part of the interest cost. My simple rule is, if the dividends don't cover the interest, I'm over leveraged. So here are my 5 rules for using margin safely. Rule number 1, I only use margin for income generating assets. If I borrow, it must be tied to something that pays me, like high yield ETFs or covered call funds. Rule number 2, keep margin under 10% of portfolio value. Okay, or maximum I can go is 15%. This will give me breathing room if market drops 20 to 30%. My current level is 5.7%, so well within my comfort zone. Rule number 3, maintain liquid collateral. So in my case, I use SGOV or S-Gulf. So I have $50,000 worth of S-Gulf, which acts as a safety buffer. It's like having an emergency fund sitting inside my brokerage account. Rule number 4, reinvest dividends to reduce margin. Whenever dividend comes in, they automatically shrink my margin balance. So my debt is quietly reducing month by month. And lastly, rule number 5, avoid emotional deep buying. When everything turns great, it's tempting to buy aggressively with margin. But I don't do that. I only add small pre-planned positions. As I like to say, use margin like seasoning. Just enough to enhance the flavor, but not to ruin the dish. So here's an example how it works in practice. Let me show you again how this looks in numbers. If my $7,800 margin cost me $45 per month, and my ETF generates over $3,000 per month, then my interest is only 1.5 to 2% of the total income. And that is sustainable. Alright, if the market dips, I'm still collecting cash flow, which gives me flexibility to either pay down margin or buy more income assets. So here's a quick recap and a checklist for you. Alright, keep margin below 10% of your portfolio. Borrow only for income generating assets. Maintain a liquid buffer like S-Gulf. Alright, make sure your dividends is greater than your margin interest and have clear rules on when to reduce debt. Alright, just remember, margin is a tool for flexibility, not a shortcut to get rich faster. So that's how I use margin safely. It's small, it's controlled, and it's backed by consistent income. The goal is not to borrow more, the goal is to sleep well at night, while still having the flexibility to invest when opportunities appear. If you found this useful, just give the video a like and subscribe to the channel. I would also like to invite you to share your experiences. How do you use margin safely, and what's your personal rule for staying out of trouble? Alright, thanks for watching, and I'll see you in the next video. Bye.